It's 2025, and your portfolio is generating monthly income while riding tech's highs and weathering market lows. Sounds like a dream? Let's make it your reality. If you have been to our channel before, you know that we love SCHD. But 2025 is set to disrupt all expectations, and you can't be overprepared. As you know, 2 is better than 1. And today, we're applying the exact strategy to our dividend portfolio. SCHD and JEPQ. They're the buzz of the dividend investing scene. These two together offer a dynamic mix of value stocks, tech exposure, solid dividend yields, and smart risk management. Whether you're aiming to build a passive income, expand your portfolio, or simply keep your investments stable amidst market fluctuations, this combo could be your golden ticket. Stay tuned as we dive deep into how they function, why they complement each other so well, and how you can leverage this strategy for your benefit. Chapter 1. Overview of SCHD and JEPQ. Alright, let's get acquainted with these two ETFs. First, we have SCHD, the Schwab US Dividend Equity ETF. It's a darling among dividend enthusiasts, and here's why. It boasts a steady dividend yield of around 3.5% and has consistently increased its dividends year after year. Over the past decade, it's averaged an annual return of about 11%. That's impressive. SCHD zeroes in on high-quality value stocks, so you won't see a heavy tech presence here. Instead, it's all about sectors like financials, consumer staples, and industrials. And with an expense ratio of just 0.06%, it's incredibly cost-effective. Next, there's JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. This one's the income powerhouse. It offers an eye-popping yield of about 10%. How? Through a covered call strategy where it writes options on Nasdaq 100 stocks, pocketing premiums to distribute as dividends. Here's the kicker. It only has 80% market exposure, which helps soften the impact when tech stocks take a dive. Together, SCHD and JEPQ offer a cocktail of value and growth, income and stability. SCHD provides that dependable foundation, while JEPQ injects some excitement with its tech focus and hefty income generation. They complement each other beautifully. When one isn't performing, the other one often picks up the slack. Chapter 2. Why SCHD and JEPQ pair perfectly. Now that you've got the basics down, let's dive into why SCHD and JEPQ are like peanut butter and jelly in the world of ETFs. First up, diversification. SCHD isn't big on tech. It's all about those value stocks in areas like financials and consumer staples. JEPQ, however, is all in on tech and growth, with a heavy tilt towards Nasdaq. This minimal overlap is key for a well-rounded portfolio. You're not risking it all in one sector. Then there are their complementary strengths. SCHD is your go-to for steady, reliable dividend growth, even when markets are shaky. JEPQ, with its high dividend yield and covered call strategy, adds some zest. It's like having a cautious friend and an adventurous one in your team. When tech takes off, JEPQ's in the lead. If there's a market dip, SCHD stands firm thanks to its value focus. Now, let's get into tax considerations. SCHD's dividends are mostly qualified, which means you're looking at lower capital gains tax rates if you're in a taxable account. JEPQ, however, dishes out non-qualified dividends, taxed at your regular income rate. But here's a smart move. Stash JEPQ in a tax-advantaged account like a Roth IRA, and you dodge that tax bullet. Lastly, let's look at their historical performance. Together, they've managed to provide consistent returns while smoothing out the market's roller coaster rides. JEPQ's covered call strategy helps soften the blow during downturns, while SCHD keeps the dividends flowing. It's a match made in investment heaven. So, the bottom line? SCHD and JEPQ complement each other beautifully, offering you growth, income, and risk management all in one package. They're like investment soulmates. Chapter 3: Practical Application of the Strategy. Now let's get down to how you'd actually use SCHD and JEPQ in your investment mix. Here's how to make it work for you, step by step. First off, portfolio allocation. A good starting point might be a 50-50 split between SCHD and JEPQ. This gives you a nice balance of SCHD's stable dividend growth and JEPQ's high-yield income, aiming for about 7% annual yield. Feel free to adjust this ratio though. If you crave more income, you might tilt towards JEPQ. For more stability, lean into SCHD. Now, let's look at the current market environment. With interest rates potentially dropping in 2025, dividend stocks like those in SCHD could become more attractive as people look for alternatives to fixed income. Meanwhile, the tech sector, particularly AI, might continue to fuel JEPQ's performance. This makes the timing for this combination particularly appealing. On to income potential, this isn't just about growth. It's about generating a steady income stream. If you're in retirement or just need to boost your cash flow, these ETFs can provide that monthly dividend check. JEPQ's higher yield can help with immediate cash needs, while SCHD supports long-term income growth. Here's a smart move. Use tax-advantaged accounts. Put JEPQ in a Roth IRA to dodge taxes on those non-qualified dividends. SCHD, with its qualified dividends, is flexible. It can sit in both taxable and tax-advantaged accounts. But remember, flexibility is key. This isn't a set and forget strategy. Monitor market trends and adjust your allocations accordingly. If tech cools down, maybe you can cut back on JEPQ. That's the strategy in a nutshell. Practical, adaptable, and crafted to provide both income and growth. Chapter 4: Risks and Considerations. Now, let's not get ahead of ourselves. Every investment strategy has its risks, and this one is no exception. First up, volatility. JEPQ's deep dive into tech stocks means you're in for some roller coaster rides. Tech can swing wildly, and if the market takes a nosedive, JEPQ will likely take a hit too. SCHD helps to stabilize things, but you've got to be prepared for some turbulence. Then there's the matter of taxes. Remember, JEPQ's dividends are non-qualified, which means they're taxed as regular income. If you're holding JEPQ in a taxable account, this could significantly dent your returns. The workaround? Place it in a tax-advantaged account like a Roth IRA or 401k. Also, consider the growth trade-off. SCHD focuses on value, which might not keep up if we're in a market where growth stocks are the stars. If you're chasing those high-flying returns during market booms, this combination might not be up your speed. It's built for balance and consistency, not for racing to the moon. And don't forget about allocation discipline. It's easy to get swayed by one ETF's performance and shift your allocation a bit too much. But the magic of this strategy is in the balance between SCHD and JEPQ. Going off script can lead to higher risk or lower returns. The takeaway? Stay on top of things. Be ready to adjust as needed. Chapter 5: Alternative Pairing Options. Now, SCHD and JEPQ might not tick all of the boxes for some people. No worries. There are other combinations out there that might suit you better. Here are a few options to consider. If you're into SCHD stability but crave a different kind of growth, try pairing it with QQQ or VOO. QQQ loads you up with tech exposure, while VOO offers a slice of the broader market through the S&P 500. Both can give your portfolio a lift during those market highs. Wanna up your dividend game? Consider coupling SCHD with DGRO or VIG. These ETFs are all about growing dividends and stable income. Sure, there's some overlap with SCHD, but they can still diversify your income stream. For those chasing higher income with a bit less risk, look at JEPI. It's similar to JEPQ using a covered call strategy, but on the S&P 500. It offers a similar yield, but with potentially less volatility, which might be more your speed if you're a bit more conservative. Each of these pairings has its pros and cons. The trick is to align them with what you're aiming for, be it growth, income, or a mix of the two. Now, let's tie everything together and discuss your next moves. Chapter 6. Key Takeaways. SCHD and JEPQ are the go-to team for dividend investors eyeing 2025. SCHD is your rock, providing stability, consistent dividend growth, and a foundation in value stocks. JEPQ, on the other hand, is your high-yield star, bringing in income with a focus on tech and a strategy to mitigate risk during market dips. Together, they strike a balance offering growth, income, and risk management. The synergy between these two is what makes this pairing special. SCHD's steadiness balances JEPQ's tech-oriented ups and downs, and their minimal overlap means you're not putting all your investment eggs in one basket. Plus, smart tax planning, like parking JEPQ in a Roth IRA, can help you keep more of your earnings. But here's the thing. The investment world doesn't stand still, so neither should your strategy. Stay vigilant, adjust your investments as the market evolves, and ensure this duo matches your investment goals, whether it's income, growth, or a blend. So, are you on board with this strategy? Do you think it might suit your portfolio? Drop your thoughts below and share this with someone else on their investment journey. Thanks for tuning in. Catch you in the next video.